Okay, let me get started. I think other students might confusing about the weather in the online classes. So let me send out another email to all the other students to remind them. So anyway, I'm going to record this lecture and after the class and post on YouTube. So the students who miss these courses will get a chance to review the recorded lecture. So this the courses, let me Okay, I sent this email to all the other students so they can remind them.
Yeah, I think maybe they thought that because the school was closed, we got the like notification that maybe they just forgot. But
Yeah, I think, yeah. So we are not worried about the weather, so we stay at home, so should
yeah,
be. Yeah. Okay. Um, okay, last time I remember, so we talked about the bank deregulation. So I hope, all the other students are safe and stay at home so they can turn on their computer so they can join in right away. Okay. See, we got more students coming. Yeah, a lot of more. Okay. Okay, so very good. So we talked about last time, the main topic is bank deregulation. And you can see in the United States, we have the banks in the United States. They have 12 different branches. US Bank, Decentralized. Okay, this is the one is called is the US banking system decentralized. The Fed is called a decentralized central bank. So that is right. So what is decentralized? So decentralized is in itself seems to be a contradiction. It works, however, because of the Fed is uniquely structured to eliminate government control, but still remain accountable to both the government and the public. There are quite a lot discussion about the role of Federal Reserve. So what is the role of Federal Reserve? Sometimes the people say, yeah, that's a independent central bank. And some people would like to say is a part of the government. But that's quite a little bit confusing because you see the chair of the U.S. Federal Reserve, Jeremy Powell, right? And he is actually nominated by the U.S. president. He was nominated by the previous president, Donald Trump. And this year, he was nominated again by Joe Biden. So he served as the chair of the Federal Reserve for both the Republic and also the Democratic. So that means, you can see most of the time the central bank is more likely kind of independent, but also the nominated by or appointed by the president. So, but it's not likely the president can fire the Federal Reserve chair immediately. So that's a very interesting story. And also you can, I would like to tell you another thing is, the chair, historically the chair of the US Fed, they have, all of them are the Jews. The Jews in the Fed chair position. I think the Fed chair position. So this is one of the, is called Jewish control of the Federal Reserve. That's a long story. The long story is not only starting from a couple years recently. It's a long time ago. So you can see most of the chair starting a long time ago, starting in most recent years, is the anti-Semitic notion that the Jews dominate and command the US Federal Reserve System, and is in fact control the world money, has surfaced across the extremist spectrum. So it's and you look at the history, like say Greenspan, right? And then you can see mostly the chair of the Federal Reserve. So now it is Jeremy Powell. Before that, the chair, all of them, okay, might say there are a lot of chairs. This is the current chair. And before that, you have Ben Bernanke. And you have, this is the, now use the US Treasury, the Treasury, the treasurer is Janet Yellen. Janet Yellen before that, she is the chair, okay? She is the chair of the US Federal Reserve. And then you have a long time ago, that's Alan Greenspan. And then you have Ben Bernanke, okay, Ben Bernanke. And then you have Paul Volcker. So all those are Jews, all of them, they have a common character. All of them are Jews, and then they are the chair, okay, before. So one of the most famous quote is that, and from Alan Greenspan. So Greenspan, very famous quote is talking about, if you understand the chair, okay, if you think you understand what the chair of the US Federal Reserve is talking about, you misunderstand. So what that means is that if you think you understand what the chair of the US Federal Reserve is talking about, you misunderstand. So that's the word they're talking about is very ambiguous. So ambiguous is implicit. So it's very vague. So it's hard to, to know what happens. Okay, what the true meaning of the Federal Reserve, the chair talking about. It's a that's a very interesting thing. Okay, so we look at the Federal Reserve, the central bank. Also, we wanted to know the investment bank. So in the United States, the investment bank, what is the investment bank doing, right? What is the investment bank doing? So the first thing is called public offering. The public offering is also called IPO. We can say there is initial public offering, and you have two, okay? And the first one is called IPO, the initial public offering. Initial public offering is the company issues stock for the first time. Okay, we call this one initial public offering. So it's from 0 to 1. So the company has no, work, offering. Right now they have more offering, and then before that they have some offering, initial public offering. And also another one is called seasonal equity offering. Okay, seasonal equity offering is also we call the secondary equity offering. So is that capital raised is a new, right? It's a new issuing equity for the company already has initial public offering. So the company already issued stock for the first time. Now they have more projects, and then they do the second round. Okay, that is called secondary equity offering or seasonal equity offering. Okay, SEO. So basically, the seasonal equity offering may involve shares sold by existing shareholders. Okay, if the shares sold by existing shareholders is called a non-dilutive. Dilutive is that means the total number of shares is not increasing, but also could be new shares. Okay, the new share is dilutive, but that means the total number of shares outstanding increases, right? Increases. So you have seasonal equity offering or initial public offering. So we have this one, remember, so it's going to be either IPO or SEO.
I have a question about the SEO.
Yeah.
If they're like, in a sense, relaunching already existing shares, is like, do they go to those people who own the shares and ask, are you willing to like sell them? Or like, how does that work where they are willing, or they want to sell existing shares?
Okay. So existing share is, okay, so you can, if you are existing shareholder, right? So you got SEO, you know that company is going to issue new stock. Okay, so usually they give the existing shareholders and more benefit. Okay, or they could, offer their like a discount of the new shares, or you can use your existing share to exchange for the new shares, and you can get a discount, something like that.
Okay, gotcha.
Yeah.
Thank you.
So the SEO and IPO both, they called, remember we have a primary market. Okay, the primary market is starting from 0 to 1. So the company and do not have that stock. Now they have new stock. Okay, that's most of the time, you see CFA exam or some other exam, they ask, so what are the typical transaction in primary market? The primary market including IPO and SEO. And not only just the IPO, so it's okay, so that's typically students need to make sure the SEO is also primary market. So once you issue the stock, you already launched new stock or a new equity. So we call that in a transaction between existing shareholders is a secondary market. So the primary market is talking about that is relative to the secondary market. Okay, so but the IPO and SEO are different. Most of the time, they require the company to prove they have a good profitability, and then they can do SEO. So if the company issue the first round like an IPO, and then they're starting to lose money, and then more likely they are not allowed to do SEO. So it's the SEO is conditional on the company's profitability and the company's financial performance. Okay, relative to public offering, also you can do a private placement. So the private placement, what is a private placement? Private placement, you cannot go public. There is no public investor. So the money is not going to go to the public, and they just goes to some particular institutions or investors. So that's called a private placement. Private placement is now need to register with SEC. So you just more flexible. You're just asking for that in potential investor. Okay, so we have private placement. Private placement offering is another way. Okay, so private placement is also called non-public offering. Is a funding round of securities which are sold not through a public offering, but rather through a private offering. So the private offering is only to a small number of choosing investors. Only to a small number of choosing investors. So those investors typically including your friends, your family members, and accredited investors and institutional investors. So they know your company, right? They know your company. More likely depends on your relationship with those investors. And then we talk about the two major methods for investment bank. They do equity offering. So one of them is called best efforts, and another one is firm commitment. Okay, I want to wonder which one. Okay, let's say this two, right? I'm going to ask you, so which one costs more for the company, for the issuing company?
I don't know for sure, but if I had to guess, maybe the firm commitment, because it sounds like more long term. Like if they're committed to something, it might be for a long period of time with their best efforts. Like maybe they can give a lot. Like it'll require a big amount of money, but maybe not for long. Maybe that would be my guess.
Okay, yeah, that's right. Is that the best commitment, the best effort is the investment bank. Okay, investment bank says, okay, I will try my best, help you to issue stock. What if the investment couldn't? Oh, they couldn't, the stock will go back to the company. So they just try their best, okay? So when you talk to your friend, you say, oh, I'm going to try my best. That means you are more conservative, you couldn't help, right? But a firm commitment is kind of you commit, you need to do, right? You commit. When you commit what you need to do, that means you have to do. So the investment bank, if they have a firm commitment, okay, that means, okay, they guarantee they will sell all the stocks. Okay, they guarantee they will sell all the stocks for the company. What about the stocks, market is not good? Okay, what do you think if the market is not good? So the investment bank couldn't sell all the stocks. Do you think the stock will go back to the company?
Can you ask that one more time?
Okay, the firm commitment. Okay, we talk about firm commitment.
Mhm.
Okay, if the stock market is not good, the investment bank make a firm commitment to the company. And the investment bank couldn't sell all the stock. What do you think the stock gonna go? Goes to the investment bank or go to the company?
Oh, back to the investment bank?
Yes, that's right. Okay. So the firm commitment is that the investment bank will take over all the stock. So the company we will not worry about. The investment bank will purchase all the stock. So some of the time, you see the investment bank become the largest shareholder of some of the company when they help those company issuing stock, right? So when the market is now good, okay, the investment bank finally end up with purchase all the stocks. Okay, in the future, the investment bank will sell those stock and subsequently, but not at that moment. They will think about some other way, to sell the stocks. Okay, basically the firm performance is going to, this one gonna charge higher. Okay, you cost higher because you have to pay higher commission into the investment bank. So the investment bank make money through charging commission of those issuing company to make profit. So if they do firm commitment, the investment bank will make more money, okay? But they bear higher risk as well. Okay, so we can see that there's a good example is that you have 50 million shares to be issued and the target price is $30 per share. And the best effort would lead to a fee of 30 cents per share. Firm commitment will lead to the bank buying the share at $30 per share. Okay, so, and if we do the best effort, the best effort can sell at $29. Okay, that is, will earn 15 million. And then if they do can sell as 32, and then they can do 15 million, right? If they do firm commitment, so the firm commitment is going to lead to that 50 million. Okay, all those 50 million shares will be purchased by the investment bank. Okay, so if the price go up to 32, okay, the firm commitment could be 100 million. So it's is that showing that this investment bank might take a higher rate, higher commission, and they charge a higher commission, but they bear in higher risk. And most of the time, in practical, usually on a best effort basis, because the investment bank, they don't want to have all their money occupied by the company, by buying stocks of the company. So they hold the company as a stock unless they don't have any other options. So that's only for the short-term purpose. They just wanted to help the company to issue stock. So the goal is to make a commission. Okay. So the commission, we also called flotation cost. Okay, flotation cost. Okay, what is the flotation? Okay, what is the flotation cost? I mean, this one is for the U.S. firm, okay, United States, okay, U.S. companies. When you're issuing stock, what is the flotation cost? The flotation cost, including the formality fees and the commission you paid to the investment bank, and also some other fees. You're hiring CPA, whatever, or attorneys, all those fees. So what do you think? Let's say, give me a percentage, your estimate percentage. What is the flotation cost for the U.S. firms to issue stock?
I'm really not sure. I'll just say 10%, even though.
Okay, good. 10%. Any other students? Any idea? You know, if you wanted to issue, let's say $100 so securities or stocks, and you will get $90. 10% will go to the investment bank. Okay. Any other ideas of what is the percentage of the flotation cost? Well, you know, other students, do you think that's going to be higher than 10% or lower than 10%? And let me ask another student. Let's see, what about Drew? What is your idea? Drew? And Ben?
Sorry, give me a second.
Yeah. Okay, other students, what about Ben? What do you think? 10% is a reasonable percentage of the flotation cost?
Sorry, I just joined on the Zoom, so I'll have to pick up to speed.
Okay. I Midell.
Yeah, I don't really know. I think you're asking me if it should be higher or lower.
Yeah, higher than 10% or lower?
Higher.
Higher than 10%?
Yeah.
Okay.
Maybe lower.
Maybe lower. You're not okay, whatever. Okay. So you know, the we talk about remember, so we're talking about the pecking order theory. Okay, the pecking order theory is talking about you use your internal fund. Okay, use your own money. Okay, internal fund that cost the less, right? And then you use a debt, okay, or bond. Okay, the debt or bond is your issuing, you borrow money, and then you issuing equity or stock. So the pecking order series is, okay, this is the order. Okay, this is the pecking order. So which one costs the highest? Issuing stock. Okay, issuing stock. So, you know, a lot of students, they talk to me about, okay, hey, you know, professor, I think issuing stock is a good strategy for the company. Why? Because you don't have to pay back, right? You don't have to pay back. So the people purchase your stock and they just purchase, invest the money, but you don't have to pay back. But for the debt or the bond, you have to pay their principal, right? In the future. So that's a misunderstanding, okay? The stock, actually the cost of the highest. The company will issue stock unless they don't have any other way to raising capital. So stock issuing is the last result. Okay, because this one is the last result. Okay, why? Because issuing stock is costly. Okay, it's a cost high. Okay, the cost high as Vanessa just talking about 10%. Okay, it's not that high, but in the United States on average is 8%. On average is 8%. 8%. 8% is still pretty high. Okay?
You put 7%.
Oh, 7%. Yeah, I'm saying it's a 7%. Okay. Sorry. So Yeah, so that is on average is 7%, but it's still pretty high. You think about you borrow money, and when the interest rate is 0, okay, and that 7% is for on average. That means a lot of people or a lot of companies they pay higher than that. Smaller company, the floating costs are higher, okay, and the smaller company will pay higher. And then the total number of the stock you issue, if you issue a smaller amount of shares, that flotation cost will be higher too, right? And if you issue a large amount of shares, is it going to be lower because they give you a wholesale price? Okay, so it's similar to the wholesale price. Okay, so the stock cost the highest. Okay, and we have that as your last result. So you don't have any other way. If you couldn't find a better option, okay, that's the last one you can do is issuing stock.
So does that mean if a company issues stock, it's probably in trouble?
Okay, you could say that, the company issued stock because it couldn't get money from debt or bond. They couldn't borrow that amount of money from anywhere else. Then they're starting to issue in stock.
So if you were to manage a portfolio and you were to see that a company issued stock, you would probably want to de-invest?
Okay, that depends. As some of the company and they wanted to raise capital, is using stock because and the shareholders, because the shareholders they wanted to issue stock. And okay, that's not only the cost, think about the cost. The stockholders, they wanted to see their stock price going up, especially some minority shareholders. And you see like a Facebook, the first time they issuing stock IPO, and then there are hundreds of employees in that company become millionaire just in one day. They promise those employees, or they give them stocks. They promise those employees that the stock gonna goes public. So the people, employee very happy. So that's they push, the CEO or the founder of the company, like a Zuckerberg, to go public. For the small company, some of the private company, they don't want to share their profit. They think that stock and issuing stock is not a good option. Especially like a Facebook at the very beginning, Zuckerberg think about that. No, I don't want to issue in stock, because when they issue in stock, that means the companies has to go public and has all the information released to the public, and also all the shareholders who bought that stock can share the company's profit.
Wouldn't a company also stay away from issuing stock if they didn't want shareholders to have a say in how they run the business?
Yeah, that's a lot of company, like a private company, they are pretty good, and they have a low debt ratio, and they don't have a stock. You look at around the world, most of the most profitable company, they are family business. They own it by their family. They don't want someone else outside to share the profit. Those companies are pretty good, but the problem is, some of the family company, they have governance, corporate governance issue, and then And when the company grow bigger and bigger, they have a lot of other issues, you know. So that's the issue for those companies. Okay, so we focus on the cost side. Okay, the cost side is that when you issue stock, it's actually the cost the highest, and and when I think in the United States we are going to we didn't see that many companies they do fraud or something before they issue in stock. And there are international stock market, there are a lot. This thing happens. A lot of company, they are trying to issue stock, and then they make a fake statement, and then they wanted to choose the best performance period to issue in stock. So when those investors, they invest in their stock, the stock price starting going down, or they tell the investor, okay, this company has a problem. A lot of people lose money because of that. So why, when you think about why the company issuing stock, and that might be some reason, information, because the information asymmetry. We are investor, we don't know, but the company's manager, they know everything. Okay, and so for smarter investor, we typically see if the top management is starting to sell their stocks, okay, we should realize that it's not a good sign, because when the top management is starting to sell their stock, that means the company gonna have a problem, right? So the flotation cost around like 7%, okay? And so how the stock price was determined? We look at the price, and okay, remember, so we have one theory is that, okay, is a IPO underpricing. Okay, this is one is very interesting. It's called IPO underpricing. What is IPO underpricing? That means the stock price is different from you sell iPhone, right? iPhone. Right? When you see the iPhone, the new model 13 coming out, they sell $999, right? After several months, are they gonna increase the price or drop the price?
After a while, I think that they would drop the price.
Yeah, that's right. Okay, they're starting to drop price. They keep dropping price, and then after 1 year, they're starting to drop price again, right? So they drops the price. So always set a very high price at the beginning. And what do you think the stock price? Can you sell very high price when you sell your stock? You want to sell the stock and you sell high price, and then you drop price. Is that the right way to do a stock price?
I think earlier, I don't know if it was pertaining to this too, but sometimes companies will put their IPO lower so that people will it'll be ensured that they buy it, since it's like a good deal per se. And then after a lot of people buy it, the price will go up.
Exactly. You set your IPO price lower at the beginning. Okay. So why this make all the people happy? And because they see the price go up, right? They see the price go up, and the manager will be happy, and also the and the employee will happy. The shareholders, all the people are happy. So I believe when you see the why they call the Yahoo Finance, it is because all the people the first day they see the price go up, they will shout out, "It's Yahoo!" You know, they say Yahoo because the price go up. So everybody happy. When you see the price go down, okay, they purchase your stocks and you sell them $100. The first thing the stock price go down, they are not happy. Okay, they are not going to be happy. They vote, use their fate in the future. So the CEO will have to resign. Okay, so I'm going to show you the one is called IPO underpricing. Is this one is called Reuters IPO. Reuters IPO, and because Dr. Reader is a professor University of Florida. Okay, and he's very good at doing IPO research. You may use this website. I'm going to type this one in your chat. You will see this one, okay, here, you know, Reuters, Dr. Reuters, University of Florida, and he did a lot of research on IPO, and one of them is called the money left on the table. Okay, so money left on the table, that means the company, they set a low price, and then the first day high price, and then you will see they calculate how much money left in there. Those are the very good example. And you see like a Snap. Okay, we talk about like a Snap company. Snap, and the first day they sell their price, okay, 17, right? The first day the price go up to 24. So the price go up. And then you see Twitter here. Twitter, they set the price 26 and the first day price of 44, right? And some other, you know, and let's say Sycamore Networks. They set price only 38 and the first day price is 184. As Akamai Technology, they set a price 26, the first day price 145. So if you buy the company as a share in advance before IPO, that's the price, 26. And the first day you see the price go up to 145. You see how many times the price go up. So you feel like, oh wow, I bought 26 and now it's 145. So you become rich. So you are happy. What about, you know, you bought, you know, they set a price 200 first day, you lose money. So, right. So this is a very interesting study is talking about the IPO and pricing. Also, we call this money is money left on the table. The money left on the table. So stock price is set low price.
Is that something that
Yeah.
all companies do? Like just like they underprice it, or if companies do like price around probably where it should stand, like why wouldn't a company underprice it if it like would shoot up the first day or a couple of days?
Okay, so that's a very good question, because one of the study talking about the stock price, actually you decide the stock price, it doesn't matter. So it's going to be the price will adjust to the real value on the first day. the first day, the company's performance or whatever the factors affect the price, the investor will determine the price by themselves. So for the first time, and the investor will make sure that is a fair price or the acceptable price. But if you issue the stock from the management perspective, okay, so if you are the CEO, you wanted to decide what is the price, and you better to put a lower price than the investor expectation. Why? Because you are hired. You are hired by the stockholders. So if all the stockholders lose money on the first day, they are mad at you. It's not going to mad at the company. They're mad at you. So next year you will be fired. So so the CEO will make sure, so make everybody happy. So we called money left on the table. So they put the money on the table. So you guys just share it. So I think this is a good, it's called Dutch auction, and how are 1 million shares allocated in this situation. Okay, so you have the 1 million shares, okay, and how you allocate which shares are gonna give to which one. There are bidders. We are going to talk about this and give the highest price first. Okay, for example, and bidder C, they wanted to buy 50,000 shares. The price they gave it is 33, right? So you gave 33, 50,000 at 33 to bidder C first. Okay, next price is 31.5. That is 300,000. Okay, you go to bidder F. Okay, you sort it out until you sold 100 million shares. Okay, this one go 33 go first, bidder C go first, and then bidder F, and then 30 and bidder E, right? And then 3025H. Okay, until you got 100 million shares split it out, sold it out. Okay, the final one, they got that price. That is the auction price. What if the final price? Okay, let's say they have the same price. Okay, in our textbook, and that is the exercise we have here. They got the same price. Okay, let me see the discussion. Nice. Okay, the discussion, right? Okay. Okay, some of the like the E and F or both they code 42, right? What about you have 100,000 shares, and both the E and F, they quote at the same price, and they want to purchase the same number of shares, right? If you have only like 20,000, okay, you're gonna have to split it into two. So E got 10,000, F will got 10,000. The enterprise is 42. Okay, so if you got E and F, and when the shares almost completely purchased between E and F, you need to split your shares. Either one got half of them. You know what I mean? Okay, so this is the one you need to calculate. Okay, so the Dutch auction is going to be sorted by the price, the highest price, and to lowest price. Okay, and then until the lowest price, that bidder will get the desired the shares. Okay, and that means how many shares left will goes to the last acceptable bidder price. Okay, the other foreign exchange we have, it could be OTC or foreign exchange. So the foreign exchange in the United States, when you see the finance, Yahoo Finance, you can see in the United States, and they have several the physical exchange. Those three are in SP 500. Okay, it's a and also you have a Dow Jones and the NASDAQ. So NASDAQ is one of them, and also you have American Exchange, and also you have a New York Stock Exchange. Those are three major national level exchange. Okay, I think that's all for today. I'm hoping to see you next Monday. We're talking about next chapter.
We're in person starting next Monday, correct?
Yes, next
Okay.
Monday we'll see each other in classroom.
Okay, sounds good. Thank you so much. Have a great day.
Okay, you too. Have a good day.